No government's going to be able to service their debt. There's going to be 50% unemployment with no government to support you. That's what I think is coming in the 30s, and it becomes all this builds up to this, but it's been building for 80 years. I mean, it's every cycle we had more excesses and more excesses, and it took more to bail us out of that cycle to the next one, and we're reaching what I call the end of a Ponzi scheme. You finally reach that point where it comes apart.
David Hunter, welcome back to the channel.
Hi, Dave. Great to be back. Thank you for having me back.
Well, it's absolute pleasure to have you. Happy New Year to you too. It's a pleasure to have you on. Whenever we do have you on, we've had you on a few times in the past. Our audience always enjoys us. Now you call yourself a contrarian macro strategist. Explain to me and to our audience, what is a contrarian macro strategist?
Sure. Yeah, contrarian comes from the fact that the markets tend to be very psychologically driven, certainly fundamentals and economics matter a lot, but the markets really are greatly influenced by psychology, the psychology of the investor. So I tend to, as a contrarian, be very much away from the crowd, particularly at the major inflection points, major turning points. So, for example, going back to October of 2022, everybody was certain the market was heading for 3,000 or lower. And I was saying, no, I think we're making a bottom here, and I'd been looking for it earlier than that. So it's not
we're talking S&P now when we're talking about
we're talking U.S. market, so S&P, Nasdaq, etc. And so I was not only a little different, but basically 180 degrees from the crowd at that point. And again, in say October of this past year, when the market was bottoming, people were getting caught up in the fact that the momentum was pointing downward and starting to talk very bearish again. And again, I was extremely bullish. And in fact, in early November said, I think we're starting the melt up. I've been talking about a melt up coming. And I said, we're in a bull leg, but the melt up's the last stage of it, or the end stage of a huge bull market rally. And I said, I think back in early November I think this may be the start of that, meaning the market rally is going to be steeper than our typical rally and is just going to continue to steepen into the top. So again, that was pretty controversial and contrary. I don't
not just controversial, but you got a lot of flack for it. I remember you were on with us early 2022. At that stage, now you were calling for Dow 45,000. Now, while we're an awful lot closer to that now than we were subsequent to that, there were a lot of people that were disagreeing with you,
to say the least, yeah, and not
always politely either.
Not always politely disagree, right? Exactly. So people do get a little confused because I put out a quarterly letter. So in January of 2022, I actually raised my targets. Well, at the same time in that letter, talking about a correction in the bull market. So I ended 2021 saying I think we've gone far too fast and we're due for a correction. I thought the correction would be 10 to 15%. Well, obviously it was more than 20% in the S&P and more than 30% or around 30% in the Nasdaq. So I was underestimating the correction. And there were a couple times, particularly in I think it was probably late February, the market had a quick reversal, and I kind of got caught in it and said, it was a one-day big reversal. I said, this may be the beginning of the next leg of the bull market. We're off to the races. And so people will pull that tweet up and point to that even today and say you were, but I quickly reversed that because that was on the eve of the Ukraine. When Russia invaded Ukraine, as soon as Russia went in and oil spiked, I reversed myself. So it was a 1 or 2 day call, and I reversed myself. But people want you to be perfect, so or they don't like you your contrarian views, so they quickly point out your flaws. Um, so,
And
but
what underpins the contrarian stance from your perspective? What led you taking these contrarian stances? Is it the kind of the wisdom of the crowd or the lack of wisdom of the crowd that you buy into?
Yeah, it's certainly from doing this for 50 years. It became apparent to me pretty early on in my career that the crowd was often wrong, and particularly wrong, almost always wrong at turning points. So when sentiment gets extreme in one direction or the other, I'm very comfortable being almost alone in the opposite stance. Now, as I explain to people, because people will, as the market moves up, say, there's a lot more people agreeing with you now. Don't you feel uncomfortable? I go, no, what people don't realize is I'm a contrarian, uh, particularly at the extreme inflection points. As the market moves, the consensus is actually often right. So I don't run away from that. It's just the place where the contrary rarely stands out is in those two, either extreme
The
bull
extremes,
market
yeah.
or extreme bear market.
I came from a trading background myself, and my old boss used to say, if everyone's long and everyone's bullish, who's left to buy? So
Exactly. Yep.
and the
Yeah,
same and the same on the downside. If everyone's short and everyone's bearish, who's left to sell?
and that's really been the crux of my thesis for the melt up call, is that rarely have we had such a consensus of bearishness going back to 2022, and even through the 2023 rally up until the last month or two, it was viewed as a bear market rally. People just said this thing isn't going to last, it's going to roll over, and they said that all the way up from the October 2022 lows. So what I look for is where's the sentiment. That's very important to me. But I'm also a macro strategist, so I'm looking at certainly a lot of macro stuff. But I think today the crux of my thesis is that people were so bearish through this last year and a half, that and stayed defensive, that what you're going to get in this melt up is, as this thing proves them wrong, there's a point, and we got to it, I think, in December, there's a point where they start feeling very uncomfortable with their defensive posture. And I think you're going to see a concentrated move, not just, certainly the institutions, but also retail, move back to the offensive side of the equation, but meaning back into equities, not just into equities, but into more aggressive equities, into the more upside equities rather than defensive. And so with that happening in what I think will be a 3 or 4 month time period, you're going to have what I will call a buying stampede, where you're going to find out how thin the market is when everybody's on the other side. So, they were all on the bearish side for a long time, so everybody's on one side of the boat. Now they're going to be running to the other side of the boat in a fairly concentrated period. And so I think we were going to see perhaps the steepest rally in history, if not the steepest, one of the steepest, which is hence my term melt up. It'll be, to give you an idea of numbers, I'm thinking the S&P can get to 7,000 in the first or second quarter of this year. That's 50% move from here in 3 to 6 months is insane, but that's what I think we're talking
a major parabolic spike at that stage.
Exactly. Parabolic is the term. Exactly.
Wow. Okay. And so let's just ensure that we create more flack for you here. What are we talking about in terms of the Dow? Where's that going? Where's the Dow going to peak out?
Yeah, the Dow. I'm in the process of writing my quarterly letter now, so I won't put out my new target. Okay. But I have had a target of 48,000, and I will say it's going to go up substantially. And same thing with the Nasdaq. I've had a 20,000. Now my S&P estimate had been 6,000 to 7,000. I was carrying a range there, and talked a lot about 6,000. So really going to 7 isn't a new target, but I am dropping the 6,000. That's how my convictions have grown, that we're going to move that much. And so the Nasdaq at 20,000 was, it wasn't behind the 6,000, but it's certainly behind the 7,000 number. So that will get raised significantly, as will the Dow. And the Russell, I've carried a 3,000 target there for quite some time, meaning, and I had said all through this rally, it will broaden. As you know, everybody was saying it's all the Magnificent Seven. It's too narrow. It's not a quality rally. It's going to die. I said, no, it's just unusually, because normally as you move towards the top, rallies narrow, leadership narrows. I said, this is going to be an unusual one where it broadens. You're going to see a very broad rally into the top. So I said, I'm not worried about the narrowness of it earlier this last year. And I think that's exactly what we saw in the last 2 months of December. Last 2 months of the year is the market was broadening. I expect that to continue with small caps maybe leading the way. So my 3,000 target on the Russell is high on the street, obviously, and way above most. And I actually am going to be raising that as well. So they're crazy numbers. I recognize how extreme they are. I keep saying to people, it's not my personality. It's where we are in the super cycle. I just think we're at the end of a 41-year secular bull market and nearing the end of what I call a super cycle, which is the big cycle, not just market, but economic cycle between two depressions. The 1930s being the last depression, the 2030s probably being the next depression.
Yeah, what's the 48,000 on the Dow? We just take that one. I mean, that's a big call. Now, if we're looking at it from contrarian point of view, there's not many people out there at all that are looking for that. So, what are the fundamentals underpinning this?
Yeah, it's a little hard for people to see because I do have a global bust as a forecast beyond this. So and an 80% bear market. So this is
global bust. You're just talking about global stock markets, all stock markets all around the world.
Yeah,
major sell-off.
Yeah, as I say, I use the term bust to describe the economy, and bear market to describe the market. So I think you're going to have a bust, meaning something bigger than 2008-9 in terms of financial crisis. A lot of involuntary debt liquidation, a lot of banks failing around the world. That's a bust. In my opinion, it'll be the biggest downturn and financial crisis since the Great Depression, maybe bigger. The economy won't be down for that long, but in the short period, it's going to be pretty nasty. So that's the bust, and a company that I think will be a peak to trough 80% decline in the stock market in the U.S. With globally, it'll be similar. And so this is a last hurrah. This upside that I'm talking is really a final flurry, a last hurrah, driven by what I explained, which is people got too bearish and have to get right with the world. And as we all know, at tops, most people are bullish, and at bottoms, most people are bearish. So they're going to get bullish at the late in the game and at the wrong time. And then I think the central banks are over tightening. There's a lag to that, so it doesn't show up right now, and everybody's talking soft landing. But I think second half of this year and into 2025, you're going to see the lagged effect of that over tightening. And because there's 320 trillion now in debt across the globe, that's why what would normally be a normal bear market and a normal recession will turn into something much worse.
Okay, so at this moment in time, you can kind of take your pick as to what is going to be the cause of a major recession going forward. Now, we've seen over tightening now with the central banks. It's not necessarily going to be the main cause of this recession. Do you think? Where do you think it's coming from? Is it geopolitical tension? Is it de-dollarization? Is it when I say geopolitical tension, the hot wars, more hot wars at this stage? Where do we think that it's coming from?
Yeah, I think all those things could play. I mean, I'm not one that's saying we're going to have some world war or that these wars are going to accelerate and cause it. I mean, they can certainly exacerbate it. I think I use the equation fragile economy caused by the pandemic. We're still dealing with an economy that because of the pandemic is underneath the surface, not right. It's fragile. Plus massive leverage, as I said, 320 trillion in global debt, and quadrillions in notional value of derivatives. Nobody talks about it, but that's leverage on the markets. It's a huge, never seen before level of derivative exposure, level of debt exposure. So we have leverage in both those areas that are far beyond last cycle. 2008-9 was unbelievable in terms of the damage, but this is we've levered up even farther. Not in U.S. banks, but across the globe in leverage. A lot of it's sovereign, of course, but and then so it's economic fragility plus leverage plus major policy mistakes, so policy error. And I do believe, whether you talk about the ECB, Bank of Japan, obviously China's got their own, People's Bank of China's got their own issues, and the Fed, across the board, I think central banks, and they're all doing pretty much the same thing, they're so worried about inflation, they don't realize how close we are to deflation. And so I think it is really central bank policy that will ultimately be the cause, but there'll be other triggers. There'll be other things that will come along.
How does deflation? We dig into that for a bit. How does deflation come about then in this environment?
Yeah, so we're all worried, and the Fed's very worried about getting down to a 2% goal of inflation, and we're getting there. We've come from almost 10% down to 3%, so we're not far away. And they're still saying, yeah, but we got to make sure once we get it there, it stays there. So they're still tightening, and there's probably a year lag to what they're doing to when it shows up. So you've got that over tightening, and I forgot the question.
Where are we getting to deflation from here?
So I think the deflation comes from the fact that once the economy turns south and the leverage kicks in, and you get bank failures, probably more centered in Europe and Canada and Australia than the U.S. this time, because the U.S. Got some religion during 2008-9. The leveraged banks are much less leveraged today, but counterparty risk means our banks are vulnerable too. So you're going to see this dominoing effect across the banks, I think, caused by the central banks not realizing how tight they were. Once that gets started, it's hard to stop, and it will trigger a very weak economy, and I think you'll see the commodities fall pretty sharply. So it's a short-lived deflation. Might last less than a year, but it's going to be deflation, and you will see both CPI and PPI, I think, in negative territory sometime between middle of this year, probably not quite that soon, more like end of this year and sometime in 2025.
Okay. Interesting call. Right. How does the dollar fare in all of this?
I am calling for now a dollar down to the DXY is one above 100, and I expect it to fall to 80 in the next 6 to 9 months. That's a huge drop. Euro, I think, euro versus dollar can get to 130, maybe higher. The pound can probably get to $1.50 versus dollar. Canadian dollar I have going to 90, versus the US dollar, and Aussie I think can get to 85, so 0.85. So there's a lot of room, I think, for the dollar to sink, and that will be very good for the metals. And then in the bust, you'll get the exact opposite. I think people will again run to the US dollar as a flight safety, and if this is truly the worst financial crisis and downturn in the post-World War II era, you got to assume there's going to be a lot of people running to the dollar. So I think you can see the dollar go from 80 back to 120 or higher, during the bust. So it sounds rather schizophrenic, big moves in both directions, both in the stock market and in the currencies, et cetera. But it's, like I said, it's where we are. I think end of super cycle type volatility.
Absolutely. Now, just you touched on metals there. Obviously, our audience very keenly interested in precious metals, so I'm keen to get your opinion on that. We've had a very strong run up in gold, having gone sideways for the last number of years. 2023 was a good 13% rally up in gold, and we closed not too far off the all-time high. There's a bit of a speculative parabolic spike there.
Yeah, you had that
towards the
overnight
end of last year.
Yep.
But we're still looking very strong. Where do we think the gold goes from here?
Yeah, I completely agree with that. I think gold is going to break out this month. And that quick spike did make a new high, but it didn't last more than a few minutes. But this time I think it'll be sustained. I see gold going to 3,000 in this period where we have a stock market melt up. So in the next and I've said, I think the stock market probably peaks before gold does prior to the bust. But my pre-bust target, whether it's middle of the year or push a little further than that, my pre-bust target for gold is 3,000. And then I think it gets hit with every other asset during the bust. So maybe it does a round trip, goes from here to 3,000 back to 2,000. I'm not sure. And silver, I have a target of 60. And silver's a lot harder for people to buy because it's lagged a lot. And it's been many years where people have been frustrated by its disappointing performance. But I think it's going to outperform gold as it always does in a bull market. And I think you're going to see silver, as the dollar heads for 80, go to 60. And I've said it lately that I would not be surprised if silver actually went as high as 75. So that's a tripling, more than a tripling from here. But my target is really 60, but I think there's room beyond that if it wants to go. And again, that's a pre-bust target. So that's, the next 6 or 8 months. And then I think silver obviously will get beat up more than gold in a bust. So silver might go to 60 and it might come back to 25. I don't know,
Sure. Just want to go back to this inflation question again for a moment. If we look at it in terms of national debt, US debt, we're piling on. It's not slowing down. And the interest cost of the national debt in the US is significant, to say the least. The only way that the US can deal with this is effectively inflate away the debt. Now, is this where we get a bit of a policy mistake because you're saying that they stay higher for longer, and as a result, potentially lose the opportunity to inflate away the debt?
Yeah, here's how this is crazy, but that one of the triggers that might happen to trigger the bust, it's the ultimate over tightening that causes it. But there's a possibility. Let's say we get this equity melt up. If Jay Powell sees the equity market above 6,000, never mind 7,000, he's going to go bananas. I mean, he bought into Bill Dudley's thesis of April 2022, hook, line, and sinker. That's why they spent the next year after that trying to jawbone the market down. Every time the market went up, out came his minions talking about, they're going to tighten more. They're going to really hit this hard because they wanted the market down. They really bought into Dudley's view that the market rallying makes their job tougher, means that financial conditions are loosening, not tightening. So imagine his mindset if he sees the S&P above 6,000. He's going to say, we can't cut rates. We can't ease. We got to tighten. You may be at a point because the market's thinking they're looking over the trough. They're saying, the Fed's going to ease. So the cycle, we may not even have a recession, or if we have a recession, it's going to be mild. We're looking past that recession. And the reason we're going to 6,000 or 7,000 is because we're starting to factor in better earnings in 2025. We're starting to factor in the fact that we're going to have a recovery in earnings, in 25, 26. And we may actually be on the verge of recession at that point. So let's say we're in spring, early spring of 2024, and Powell's looking at the market above 6,000, and he's saying, "I'm hiking." And his committee says, "We're hiking. We're not." That that could be the real negative surprise, certainly for the markets. But I think it also could be, if you're already making a policy mistake because of the lags of over tightening, that could be, they may be hiking rates on the eve of a recession that could be a pretty bad one, and they're focused on the more stock market. They don't realize how close they are to, the market rolling over and the economy rolling over. So that may be the thing that kind of ticks the top. And they may, and again, they may be doing sort of like in the Great Depression when the central banks were making moves that were basically, they should have zigged and they zagged. That may be what the central banks do this time around, is tighten right on the eve of recession when they should be saying, "Oh my goodness." So if that happens and we tip into a bust, as I said, I think this could be worse than 2008-9 in terms of financial problems. In October of 2008, when Lehman failed and GE almost went under because the commercial paper market froze, right? They almost didn't have access to the liquidity they needed. The government and the Fed acted pretty fast to free things up, or else we would have tipped into a bust, I think. So that's the difference between 2008-9 and what I think this time I think we tip into that bust. And what I mean by a bust is a free-falling financial system that they can't stop easily. That means you're going to see dominoing of bank failures, and they only have one tool that can move quickly and have any impact, and that is money, right?
Yes.
You will see more money be pumped out from every central bank, from every corner of the world, because it's going to be global. And I can only talk to the Fed's number. I talked about the Fed's numbers, but I believe, the balance sheet right now is say 8 trillion or a little below. I don't know where it is exactly, but got up to 9 trillion. The Fed's balance sheet. I think the Fed's balance sheet before this is over, in response to the bust, will be in excess of 30 trillion. So they'll be printing over 20 trillion in new money in QE. As much as Powell says today, we're not doing that again. We'll never do that again. We're trying to get away from that. When you got a free-falling financial system, they're not going to be sitting there worrying about inflation. They're not going to be worrying about the long-term effects of this. They're going to be trying to save the system. And that's true of the ECB. They'll be doing proportionally the same thing. Japan's going to be doing something like that. Bank of Canada, Australia, People's Bank of China. Everybody's going to be trying to save the system. And again, there are these leads and lags. By the time they do save the system, by the time they stop the free fall, they've gone way, way too far. And next thing you know, in the second half of the 2020s, 26, 7, 8, 9, you'll have jump-started an inflation cycle that will make the early 1980s look like a picnic. I think you'll see 25% inflation in this country by the end of the decade. So what you said before about servicing the debt, I mean, our interest costs today are $1 trillion, and which is larger than our military budget, and that's at interest rates that are 5% or 4%, or their average cost is probably below that. What happens when their interest costs are 15% on the way to 20? There's no equation out there that can solve that. And I think you get the depression in 2030s as a result of that. And that depression in 2030s, I think, comes with an entire collapse of the Western, or basically the worldwide financial system. I think no government's going to be able to service their debt. There's going to be 50% unemployment with no government to support you. That's what I think is coming in the 30s, and it becomes, all this builds up to this, but it's been building for 80 years. I mean, it's every cycle we had more excesses and more excesses, and it took more to bail us out of that cycle to the next one, and we're reaching what I call the end of a Ponzi scheme. You finally reach that point where it comes apart.
You don't paint a very rosy picture, do you?
Well, depends on which time frame you use.
Yeah, exactly. Um, okay,
Yeah,
wait.
I don't say this lightly because I mean it's easy to talk about, but
Mm,
it's going to be really dire, I think. And I keep telling people focus on this year and between now and the end of the decade, because there will be great opportunities in commodities post bust. I'm calling for $500 oil by the end of the decade. I'm calling the reason we have 25% inflation is because that money leads to a lot of money chasing a lot fewer goods.
sure.
And those goods, it's going to be an industrial recovery more than a consumer recovery. So those goods are, the commodities. So ag commodities, gold, copper, silver, all the industrial metals. Natural gas will go through the roof. Oil go to $500. So it's there is an opportunity on the other side of the bus. It's just not going to be in tech stocks or in growth stocks. It's going to be or indexes. It's going to be in commodity oriented stocks or commodities. And I tell people, you've got basically between now and the end of the decade to get your financial house in order, because those that do are the ones that are going to have the best chance to survive what happens in the 2030s. It's don't stay, as much as it sounds horrible and you want to think about it, try not to focus on the 2030s because it's so far out. Things can happen. I could be wrong. I'm painting a picture of what I see coming together, but the time to focus is this next 6 years.
I don't say this often, but I do hope you are wrong.
Me too.
I'm quite sure you hope you're wrong yourself.
Yeah, I say it even less often, but I hope I'm wrong.
Yeah, expect the best and prepare for the worst, really, is the message there, isn't it?
Exactly.
David Hunter, contrarian market strategist. Thank you for joining us on the channel again.
It's been a pleasure. Thank you.